We have talked about hedge funds, private equity, and real estate. The fourth major category that we look at is commodities. Commodities are physical products. The return depends on price changes because with physical products like gold, for example, there is no cash flow generated by simply holding the product. Generally, investment in commodities is through derivative instruments, and these derivative instruments include futures, forwards, options, swaps, and commodity index futures. The curriculum briefly describes these, but since we've covered this material in derivatives, I will not repeat the definition of futures and forwards. All I'll say here is that the most popular way of investing in commodities is through futures. In other words, if you want to take a bet on gold prices and you think that gold prices will go up, then the logical thing to do is take a long position in a gold futures contract. As you've seen in derivatives, the contracts may trade on exchanges. So futures contracts and some options contracts would trade on exchanges. Other contracts, especially forward contracts and swaps, would generally be traded in the OTC market. There are other ways of investing in commodities also, and those other vehicles are listed here. There are some exchange traded funds that do have exposure to commodities. When you invest in these exchange traded funds, you will then indirectly get exposure to commodities. Another strategy is to buy the common stock of companies exposed to a particular commodity. If you want exposure to oil, for example, you might invest in a large oil company. However, the changes in stock prices of the company and the price of oil might not be totally correlated. You can also invest in managed future funds. These are very similar to hedge funds and are actively managed. They invest in commodity futures and forwards. You can also have individual managed accounts. This is similar to what happens with stocks, where you effectively have an expert who manages your account for you and invests in the appropriate commodities. Again, the investment, however, would happen through the vehicles and instruments that we have talked about here. Specific commodity sectors, they are funds that give you exposure to particular sectors within the commodity universe. From a testability perspective, this slide is extremely important. Commodity performance and diversification benefits. Commodities are viewed as a good inflation hedge, and this is rather obvious because commodity prices have a direct impact on inflation calculation. What this also implies is that unless you are managing extremely well and extremely carefully, it is difficult to have a long-term positive real return when investing in commodities. So the main function generally of investing in commodities is that it gives you an inflation hedge. The other big important factor is that generally it is seen that commodities have a low correlation with traditional investments, and this provides a big diversification benefit. Exhibit 16 shows the monthly return correlations from 1990 to 2014, and here we see that the correlation between commodities and global stocks was 0.25 and the correlation between commodities and global bonds was 0.18. Commodity prices and investments. What we are doing on this slide is summarizing a lot of information, and again, you have probably heard this from me several times, but this is material that is covered in a lot of detail at level 2, so I'm just going to give you the basic points here at level 1. Commodity spot prices are a function of supply and demand, cost of production, value to users, and global economic conditions. This is fairly self-evident. Now, here is something that might not be so self-evident, but I'll give you the basic intuition and just take it as a given for now. We'll see details at the next level. The future price or the futures price is approximately equal to spot price into 1 plus R. And to make this discussion a little more concrete, let's say that we are talking about the futures price of gold, and let's say we are talking about gold futures prices 3 months out. So gold will have a current spot price. Let's say that the price for 1 unit of gold today is 100. The futures price would be 100 into 1 plus R to the power of T. T is the time in years till that contract expires. And the futures price is a little higher because the party that is holding the gold obviously is giving up a certain interest rate, which is why the futures price is going to be higher. Plus, it will cost money to store the gold, so the storage cost is also added. The combination of the foregone interest and the storage cost is sometimes referred to as the cost of carry, and these two items would cause the futures price to be higher than the current spot price of 100. But then there might be an advantage, a benefit, or a convenience of holding gold. That convenience is quantified into what is called a convenience yield. It is the value associated with holding the physical asset. So we subtract the convenience yield. I would say that you just memorize this whether or not you fully understood what I just said. Futures prices may be higher or lower than spot prices based on the convenience yield. If you look at this formula, and if we say that the convenience yield is very low or close to zero, then the futures price is going to be greater than spot price. When this happens, we have a situation called contango. On the other hand, if the convenience yield is so large that it offsets the cost of carry, then you will have a situation where the futures price is less than the spot price, and this situation is called backwardation. Again, these are terms that you should remember. And the final point on this slide is that when you invest in commodities, there are three sources of return. I'll start with the one at the bottom, which is the most obvious, spot prices. Obviously, if you invest in a gold futures contract and the price of gold goes up, that means gold prices are going up in the spot market, then that is a source of return, that is a benefit. The second point has to do with collateral yield. You might recall from our lecture on futures contracts that when you get into a futures contract, you need to post what's called initial margin. And in fact, you need to also maintain a certain amount of margin in your account. This margin can be thought of as collateral. It is really your money which is being kept in the account. This collateral is invested in safe and liquid securities such as T-bills, so you get a return. That return is called the collateral yield. And the third category or the third source of return is roll yield. Roll yield is the yield that you get if the spot price does not change. Let's take a situation here where for a given commodity the spot price is 100 and the market, let's say, is in backwardation such that the futures price is 95. Say that there is a very high convenience yield because of which the futures price is 95. If you get into the futures contract, you will get into the contract at a price of 95, which means that you get into the contract over here, and when the contract matures, you will pay 95 and get the underlying. If the spot price stays 100, then you will get the underlying for 95 and you can then sell it in the market for 100. That will give you a return of 5. This 5 is called a roll yield. So you can just remember this fact. When the market is in backwardation, there will be a positive roll yield. If the market is in contango, then there will be a negative roll yield. The next category is infrastructure. Assets underlying infrastructure investments are real, capital intensive and long lived. These assets are for public use and provide essential services. Most infrastructure assets are financed, owned, and operated by governments, but now increasingly infrastructure assets are being financed privately, and hence we are studying this segment here. Categories of infrastructure investments. Broadly speaking, infrastructure investments are categorized based on underlying assets. A commonly used categorization is economic investments versus social infrastructure investments. Economic infrastructure investments include investments in transportation and utility infrastructure. So under transportation, we can have roads, bridges, railways, and so on. Under utility, we can have energy companies, waste management companies, transmission companies, and so on. Infrastructure investments can also be categorized based on the stage of development of underlying assets. Existing investable infrastructure assets, which have an operating history and a financial history, are sometimes referred to as brownfield investments. The assets may currently be owned by a government, and the government might be wanting to privatize the assets. Investing in infrastructure assets that are to be constructed may be referred to as greenfield investments. Investments can also be categorized based on geographical location. Forms of infrastructure investments. Broadly speaking, we can make either direct investments or indirect investments. Direct investments will be extremely expensive and lead to concentration risk. That's why most investors invest indirectly in infrastructure investments. Forms of indirect investments would include buying shares of companies that deal with infrastructure, or buying exchange traded funds, or participating in private equity funds, and so on. Indirect investments can further be subdivided into publicly traded infrastructure investments and private investments. So clearly an investment through a private equity fund would be a private investment, but in private investments, liquidity will be a concern. If investors want relatively high liquidity, then they should invest in publicly traded infrastructure securities. However, investors should be aware that publicly traded infrastructure securities represent a small segment of the infrastructure investment universe. The final point, and perhaps the most important point on the slide, has to do with risk and returns. Now, generally, with infrastructure projects, cash flows are relatively stable, which means that the risk is low. Another point is that the correlation with traditional investments is low, which means that there is a diversification benefit of investing in infrastructure projects. Infrastructure investments also provide a good inflation hedge because the value of infrastructure projects increases if there is high economic activity or if there is high inflation. Now, within the universe of infrastructure investments, there will be several subcategories that we've talked about, and the riskiness within the infrastructure segment will depend on the predictability of cash flows. If we have a brownfield investment with predictable cash flows, then the risk will be relatively low. On the other hand, a greenfield investment where we are uncertain about future cash flows, there the risk will be relatively high. A risk which is inherent to many infrastructure investments is regulatory risk. This is because essential services are being provided, and governments typically regulate many aspects of infrastructure investments, including the sale of underlying assets, operations of assets including service quality, and price and profit margins. Other alternative investments. What you are looking at here is a list of collectibles. The curriculum doesn't say too much on this, so I don't think it's overly important, but you can recognize that these items are extremely illiquid. So in general, we've talked about several categories in alternative investments being relatively illiquid, and examples were private equity, hedge funds. If those categories are illiquid, then these categories are even more illiquid. So the risk associated with these items tends to be high. Now, my piece of advice on this material is that it doesn't make a lot of sense to invest in these because of the possible return, because the risk is too high. It makes sense to invest in these items if you really like these items and you derive a lot of pleasure by holding on to these items. That, by the way, is not explicitly part of what the curriculum says. The main point from the curriculum is that these are very illiquid and hence the risk is very high. Finally, risk management. We've talked about the risks of various categories of alternative investments. Here we just pulled together a few major points. It is important to recognize that investment and risk management is a process where both the investor and the risk manager, or here we can say the investment manager, should be concerned about risk management. You can't, as an investor, say that my fund manager is going to worry about risk, because if you think about it, each alternative investment will have a separate manager. So you need to take a holistic view and think about risk as you allocate your funds across different managers. Risks vary across alternative investments. The risks associated with commodities are different from the risks associated with private equity, which would be different from the risks associated with real estate. Historical returns and risk or standard deviations might be biased. We've talked about this several times. If you look at hedge fund indices or private equity indices, the returns will tend to be biased upwards because of various biases. We've already said this multiple times, and I'll say it again, that with hedge fund indices and private equity indices, the indices are created based on the constituents reporting data voluntarily. So that obviously creates issues. Also, there will be certain reported correlation numbers, but correlation numbers keep changing. If you look at some of the exhibits in the curriculum, you will find time periods where correlation numbers are relatively low. There will be other time periods where the correlations go up. So you need to do your due diligence and figure out what's the appropriate correlation number to use. And these correlations are important because they will impact the diversification benefit. You should also recognize that traditional risk measures such as Sharpe ratio, which depend on expected returns, standard deviation, these traditional measures generally assume a normal distribution of returns. But many alternative investments do not exhibit normal distributions. They often use derivatives, which means that the risk profile might be asymmetric, they might be high kurtosis, there might be skewness. So purely relying on the Sharpe ratio doesn't always make a lot of sense. You should also recognize that with alternative investments, there is limited transparency. This is partially because the industry is not as well regulated or not as regulated as, say, the regular traditional investment industry. Also, the instruments or the underlying instruments tend to be fairly illiquid, which means that the funds, the hedge funds and the private equity funds also tend to be somewhat illiquid. As we've said several times, due diligence is important, especially due diligence of alternative investment managers, because the work here requires a lot of skill and you want to identify the managers who you believe have the necessary experience and skill. What I have done here is simply reproduced a slide which I used in an earlier reading, Security Market Indices. This was the one slide that talked about the indices for alternative investments. And since this connects with what we are talking about, I have reproduced it here. So I suggest you read through this again. It will be a good refresher. A quick summary now of what we have talked about. You need to understand the general characteristics of alternative investments. If I were to mention the most important ones, these require very active management. Many alternative investments tend to be illiquid. Mostly alternative investments is the domain of high net worth individuals and institutions. We then talked about the four major categories of alternative investments: hedge funds, private equity, real estate, and commodities. For each of these, you need to know the basic description. You need to know the various strategies or categories and then subcategories. For example, with private equity, we have venture capital and leveraged buyout. With hedge funds, we had different strategies such as equity-based strategies, relative value-based strategies, event-based strategies. So you need to know the strategies at a high level and then a little bit about the sub-strategies. With real estate, we have different categories such as commercial real estate, residential real estate. Then we also talked about REITs, mortgage-backed securities, and so on. You need to understand the basic benefits and risks. One of the most important benefits that is frequently cited is the diversification benefit. And we need to be careful before just accepting that at face value. We need to actually look at the current correlation numbers or estimate the correlation numbers to determine whether there is a substantial diversification benefit. Generally, commodities tend to offer the best diversification benefit, but the return on commodities generally will be close to zero. This is the real return. You need to understand the fee structures. In fact, if I were to take a guess as to the most likely question from this reading, my guess would be that there will be a question on hedge funds related to fee structures. And I say that because a lot of examples deal with fee structures, especially for hedge funds. And then even the fee structure for private equity is somewhat similar. Due diligence is important. Make sure you know the due diligence list that we talked about when we were discussing hedge funds, because those same due diligence items are then repeated for the other types of investments. And finally, we talked about risk management. You need to recognize that risk management is not just the domain of the fund manager. The investor also needs to worry about risk management. Also, traditional risk measures such as standard deviation, which rely on normal distributions, might not apply in the world of alternative investments, especially where the returns do not have a normal distribution. So that brings us to the end of the reading. Go over the summary in the curriculum, review the learning objectives. I have referenced all the examples. If you did not do them while listening to the lecture, do them now. Do the practice problems in the curriculum. Unfortunately, we do not have too many. Therefore, you should also do practice questions from other sources. That is it.